Welcome back, folks. My name is still Martin Jones, and I am still talking to you about how to answer a P2 question in 10 easy steps. We're on to step 2 now, and as you might recall from my previous presentation, step 2 is talking to you about part A. Now, hopefully you have downloaded the exam question Kate. Kate appeared in June 2010, the P2 exam in 2010, and as you can see, I've downloaded my copy here. Now, I'm not going to read part A to you now. That's what I'm going to do in the next presentation. What I'm going to do in this presentation is I'm going to talk to you about the knowledge required in order to answer part A. So I'm not actually going to work my way through the scenario now. I'm not going to do that. I'm going to put it down. I'm going to show you the knowledge that is required for you to answer part A. And then what I'm going to ask you to do is to see if you can apply that knowledge and see if you can answer part A on your own before I come back to step 3, and then I'll answer part A. And that's how we're going to work it. Basically, I'll show you the knowledge, you have a go, then I have a go. I'll show you the knowledge, then you have a go, then I have a go. Part C, same again. I'll show you the knowledge, you have a go, then I have a go. Then part D, I'll show you the knowledge, you have a go, then I have a go. Okay? Part A, knowledge. The knowledge that you require in order to answer part A relates to deferred tax, which is a strange subject, to say the least. A very technical subject with a lot of number bashing. It essentially ends up being arithmetic, as you can see from the equation here on my left. So let me read it to you. I'm going to have to look down because it's not actually on my left. I'm just looking at an empty space. What I have is I have the slide in front of me on the computer. So I'll have a look down and you have a look at what I'm saying. Deferred tax. Deferred tax is given by a formula. Deferred tax is equal to the temporary difference multiplied by the CT rate. And that's the mathematical definition of deferred tax. Temporary difference has its own equation and is defined as follows. Temporary difference is the difference between two assets. One on the statement of financial position, which is the carrying value, and the other one in the tax books, which is known as the tax base. So temporary difference is a temporary difference between two carrying values, one the carrying value that the accountant has, and the other the carrying value that the tax accountant has. So one, the carrying value that the financial accountant has, and the other the carrying value that the tax accountant has. So what? Well, the specific application of deferred tax in the context of Kate Part A is related to deferred tax and losses. Now, it's a highly mathematical subject, deferred tax, so to illustrate what happens when you have losses, I've got a little question with some numbers so you can hopefully get your head around this. So what happens if you have losses? How does that affect deferred tax? Here's a little question. The taxman is carrying forward losses of 100 million and the CT rate is 30% and the requirement is DT effect. Now the taxman is carrying forward losses of 100 million. CT rate is 30%, required is DT effect. Now have a look at the answer. The answer, can you see, is a bit of a table. We're going to have the carrying value, compare it to the tax base, deduct one from the other, that gives us the temporary difference. We multiply the temporary difference by the 30% and that gives us the DT. Now there's a rule as regards DT. When you get positive DT is usual DT, and usual DT is usually a liability. So positive DT is a liability, therefore negative DT is an asset, it's a DT asset. Well, that's the mathematics. What about the detail? Well, what happens as a financial accountant when you make losses? Well, you actually make your losses on the income statement, don't you? So those losses are made on the income statement, then they just get lost into equity. If they get lost into equity, they're just lost in equity. They're not assets, they're not liabilities, they're just lost in equity. So what is the asset and liability value on the balance sheet of something that's not in assets or liabilities? It's zero, isn't it? We don't have an asset or a liability for losses. We just lose them in equity. So the financial accountant is carrying a carrying value of zero. But what about the tax accountant? Well, the tax accountant does something weird. When you make losses, in this case losses of 100 million, do you multiply the loss of 100 million by 30%, send off to the taxman, and he gives you back 30 million? No, you don't get your 30 million back from the taxman like that. What you do is you pretend that the loss, which is actually 100 million, you pretend that the loss is 0 million. But what you get to do with that 100 million is carry it forward. Now here comes the tricky bit. You do carry forward losses, and when you carry forward losses, it sounds like a bad thing, doesn't it? It does sound like a bad thing. Making the losses in the first place, that was obviously not good. That was a bad thing. But when you carry forward losses, when the tax accountant carries forward losses, those losses will be set off against future profits, and they will reduce the amount of tax that's paid. So it's a tricky thing, this, but what the tax accountant does is carry forward the losses as if they were assets, as an asset. So we have an asset value of 0 in our financial accounting books. The tax accountant has an asset value of 100 million in the tax books, and 0 minus 100 million gives you minus 100 million. You multiply minus 100 million by 30% and you get a DT asset of 30 million. There you go. A very quick resume of deferred tax on losses. So now that I've shown you the basics of deferred tax on losses, what I want you to do is to take that knowledge, which is fairly minimal, and see if you can use that knowledge to analyse the scenario Kate Part A. So what I want you to do now is to have a go at Kate Part A.